everybody, a big rally on the stock market today, and here to talk about it is Mark Collinsworth, the CIO of Vera Global Wealth Management. Mark, what happened? It sounds like a good thing.
Well, it kind of was. The inflation numbers came in a lot better than expected, so that caused interest rates on the 10-year Treasury bond to drop dramatically, which sparked a rally on Wall Street with the Dow going up 489 points, S&P up 84 points, NASDAQ up 326. And now everyone's saying the Fed is completely done raising rates. There's no more reason to raise interest rates. And they're actually now, a lot of your Wall Street firms are actually saying the Fed's going to start cutting rates sometime in the next 3 to 5 months.
So that in itself should stimulate even more economic health.
It should, in theory, whenever the Fed cuts interest rates, it should stimulate growth. But I'm a little skeptical that the Fed's going to cut interest rates that soon. Their inflation target is 2%. The inflation numbers right now are 3.6, but the CPI is kind of gamed out. So I'd say the real inflation number is probably pushing closer to 6, in my opinion.
So was this unexpected, the
It
rally?
was very unexpected. No one was expecting the numbers to come in that low.
So why was that? Everybody's been
Uh,
talking gloom.
well, part of it was the dramatic drop off in gasoline prices. And of course, you have to ask the question, why are gasoline prices and oil prices dropping so much? Historically, when you see oil drop like it has over the last several weeks, that's usually an early warning sign that you're heading into a recession.
Okay, so from the reports I've been reading, gas prices have dropped now because, at least in part, maybe in large part, because the surge of post-COVID travel has kind of eased off, and airline fares have dropped for the same reason. Correct?
Correct. And that the bigger reason I think is, OPEC has been making major oil cuts to production over the past year. Now the OPEC economies are starting to suffer and people are starting to lose their jobs because those oil rigs aren't working at full capacity. And so the belief is that the OPEC nations are going to have to increase production to stimulate growth. Whereas here in the United States, interest rate cuts stimulate growth. In the OPEC nations, increase in oil production stimulates growth.
Now, what about the continual tapping into the Strategic Petroleum Reserve? That Biden did that to lower prices to some extent, and he's still doing it. Can he keep doing it?
Well, no, because he's pretty close to running out of oil in the SPR. And that's another problem. He's got to replenish it. But we all both know that Democrats hate the military and they could care less we even had one.
So, can we assume then that gas prices will not stay somewhat lower as they've dropped now somewhat lower?
Well, I think they will stay lower for the simple reason I think your OPEC nations are going to have to increase production to keep their people from getting upset that there's a recession starting in their nations.
All right, so what's the outcome now in the next 6 months to a year since things seem to have taken a positive turn?
Well, I don't think the Fed's going to actually cut interest rates. They won't cut interest rates until their inflation target is actually reached, which is 2%. Going from 3.6 to 2, that's still a big number. The economy is still slowing. So I think you're going to see that at your best case scenario, in my opinion, the Fed will not raise interest rates anymore, but it's going to be a while before they actually start cutting rates.
Okay, now also in terms of the inflation, Biden's been saying, inflation's under control. Several months there was zero inflation, but that is really deceptive. What it means is there was no appreciable increase for that month of the inflation that's already very high over what it was when he took office, correct? So, I mean, inflation
Right.
really hasn't come down. It just hasn't risen that much more recently.
Well, and I think if you look at the CPI numbers are very gimmicked, and the reason why they gimmick them is because Social Security is based on CPI, so it's in the government's best interest.
Excuse me, that's Consumer Price Index for those who may not know that.
Yeah, consumer price index. So it's in the government's best interest to make the COLA adjustments, cost of living adjustments for Social Security, to make them as low as possible so the government doesn't have to pay as much money out to Social Security. And there's actually several websites out there that try to calculate inflation without the tricks that the government uses in it. And those websites think the inflation is actually somewhere closer to 7%.
Yeah, now also, I mean, some of the staples like food still remains high. A lot of the commodities still remain high, don't they?
That's correct. I mean, I was just at the grocery store yesterday, and there were several items that are like my favorite items that just weren't on the shelves, and I haven't seen them on the shelves in like, several weeks, if not several months.
So what do you predict now for the rest of the week with Wall Street, the rest of the remaining part of the week?
Well, well, we are now, historically, the old saying, sell May, go away, come back again Halloween Day. What that means is from basically May 1st through Halloween, October 31st, those are the worst performing 6 months of the year. And basically now that starting November 1st, between November 1st to May 1st, historically is the best performing year part of the stock market, with November, December, and January basically making up the bulk of the entire returns for the entire year. So we're actually right now in the 3 months that usually produce the highest amount of returns historically for the stock market.
And after that,
After that, we start getting into February and April, and then we're gonna have to see, because once we start getting into May, well, then the market goes in. But I say that next year's an election year. Election years are historically famous for not going up a lot, but not going down a lot either.
and that of course, it has because of the political implications.
Yep.
And does the Fed is the Fed influenced by that?
Well, when George Bush ran against Bill Clinton back in 1992, the Fed raised interest rates, and a lot of people blame the Federal Reserve for tilting the election towards Bill Clinton for that reason. The Fed historically has tried to now stay far, far away from doing anything with changing interest rates in election years, and I think they'll probably stay by that playbook unless the economy gets really bad like it did in 2008 and they started cutting interest rates like crazy.
Now, maybe too far down the road yet to make a prediction, but come election day, what kind of shape will we be in economically? And what will it mean for Biden's reelection if he's still running for president?
Ooh, that's a good question. I think the biggest wild card coming into the election is you are seeing a lot of Democrats actually step in and actually want to run against Joe Biden, citing, his mental capacity, his age. And let's not forget the woman that ran in 2016 for the Green Party. I forget her name. A lot of people blame her for causing Hillary Clinton to lose, because that candidate for the Green Party actually took so many votes away from Hillary Clinton. It shifted the tide dramatically towards Trump. She's running again this year against Joe Biden.
All right, but again, in terms of the economy by election day, what shape will the economy be in?
I think it will be worse.
Worse. Not good for Biden.
Not good for Biden. Biden's in a very tight situation, but what's keeping them alive right now is all this government spending. They have the Inflation Reduction Act, which isn't really reducing inflation; it's actually causing inflation in the sectors that it was meant to lower. I think with all that government spending, that might be able to keep the economy from slipping into a full recession by election day, because they won't stop spending money. We now pay $1 trillion in interest a year on our debt.
Yeah. And again, as we keep that ratio up and increasing between what we take in and what we're spending just on interest payments, it is unsustainable in the long run.
Correct. I mean, to give you an idea of what $1 trillion looks like, do you know what was happening 1 trillion seconds ago? Not a trillion hours, not a trillion minutes, 1 trillion seconds ago. Do you know what was happening?
I have no idea.
Cavemen were actually drawing on the walls. It actually comes out roughly to 28,000 years. And then to give you an idea about what billions are, do you know what was happening just a billion minutes ago? Not a billion days, a billion minutes ago.
Yeah. What?
The Roman Empire was actually invading Great Britain.
Really? Yeah. So yeah, that does give you some perspective. So, but once again, wrapping it up now, even though there's a rally, it seems like good news. People are getting excited. Optimism may be increasing. You're saying by election day, so a lot of that will evaporate.
I believe so.
All right, Mark Collinsworth, the CIO, that is the Chief Investment Officer of Vera Global Wealth Management. Thanks once again for the update.
Thank you, Larry. And as always, don't worry, people. It's always the darkest because it just gets really effing bad.
You're such an optimist.
Thank you.
Another bright note to end on. Mark, thanks.